Amazon reported fiscal year 2022 third quarter results after the markets closed on Thursday, October 27. Investors did not like what they saw from Amazon. The stock was down over 8% on the day following the earnings release. So let's take a look at its figures and try to understand what investors were disappointed about. And the main theme here is that Amazon's expenses are rising faster than revenue. Overall revenue increased by 15% in the third quarter to 127 billion. There was a $5 billion impact from the changes in foreign currency impacts. Earnings per share of 28 cents was down from 31 cents in the same quarter last year. So despite revenue increasing by 15%, double digits, earnings per share was down. The company invested aggressively in expanding its capacity ever since the pandemic's onset, when consumers flocked to amzn.com to order things that they needed and things that they wanted when brick and mortar retailers were closed. Amazon was not ready to deal with the significant influx of customers and customer orders, and so they invested aggressively in hiring and adding warehouse capacity and adding logistical capacity, and those investments are now weighing on its cost structure. As sales growth has slowed down, those costs remained elevated, and in fact they invested a little too much to compensate for the boost in demand, as these things are difficult to precisely match up when you get a surge in customer orders. When you're a business that does hundreds of billions of dollars in sales, it's hard to precisely measure how much increase in capacity you need. How many more employees do you need? And so Amazon's management said, let's err on the side of over-investing, and that way the customer experience is not compromised. Customers still get a healthy, an exciting customer experience where they can order online and have the order delivered to their home within 2 days or less, and next day even for some items in some cities. So Amazon did not want to compromise that part of their customer value proposition and said, you know what, it's okay if we overinvest and have a bit more expenses, as long as we take care of the customer experience. However, that's not sitting well with investors, and that's partly why the stock is down 8% following the earnings release. Is all those extra investments, while yes, it's great news for customers, it's not great news for the bottom line, and it's not great news for investors. And that led to operating income of 2.5 billion in the third quarter, which was down significantly compared to the 4.9 billion in operating income in the same quarter last year. AWS, which is its Amazon Web Services segment, generated operating income of 5.4 billion. Now you might notice that is more than the 2.5 billion in operating income the entire company generated in the third quarter, and that would be an astute observation, and you would realize that the rest of Amazon's business is losing money. It's the AWS that's carrying the business profitability wise. That the 5.4 billion in operating income from AWS was offset by a 2.5 billion dollar operating loss in its international segment with e-commerce sales and all of that, and a 4 billion dollar operating loss in its North American segment, which includes the e-commerce side as well. So all things not AWS is losing money at Amazon, and AWS is providing the vast majority of profits for the company. Another thing that disappointed investors was the guidance for the fourth quarter. Amazon is telling investors that revenue will come in at 144 billion at the midpoint in Q4. If it does meet those expectations, that would be just 5% growth year over year. That would be a deceleration from the 15% growth in the third quarter. And so because of that, they're forecasting operating income at the midpoint of 2 billion in the fourth quarter, which would be significantly lower than the 3.5 billion in the fourth quarter last year. So even in the fourth quarter, Amazon is telling investors, look, our operating income is going to be much lower than it was last year. We're not growing fast enough to offset those expenses. Personally, one thing that I was disappointed in looking at Amazon's income statement and their press release following the earnings statement was the thing that I was following was its head count, its employee count, and after falling by a little roughly 100,000 in the second quarter, employee count increased by 21,000 in the third quarter. That surprised me a little bit, and I was a little bit disappointed in that. I thought that Amazon was going to allow attrition to bring down their employee count, meaning that as employees quit, Amazon would not replace them, and so that would lower their employee count. Because in earlier conference calls, management said that they had way too much capacity, that they overinvested in warehouse capabilities and employee counts, and so that they didn't need that many employees. So I thought they were going to allow that to kind of decrease from the heightened levels following the pandemic hiring boom. But then I noticed that they actually increased headcount in the third quarter. So that was a little bit discouraging to see, because I was hoping that Amazon would allow those employee counts to decrease, and thereby that would decrease its operating expenses and help profitability rise as revenue increased and employee count decreased. But now that employee count is increasing again and revenue is only expected to increase by 5%, I don't see a pathway for Amazon's profits to expand, at least in the fourth quarter and in the first quarter of the next year, if they're going to continue hiring. I thought they were going to let attrition take care of some elevated employee counts. So this was a little surprising to me. Anyhow, that's all I've got for Amazon's earnings review. The stock is down roughly 8.5% as I'm recording this on the day after the earnings release. The company has near-term headwinds related to the changing consumer behavior as economies reopen. Consumers are spending less online in the near term. However, longer term, I fully expect online sales as a percentage of overall sales to continue rising, and I expect Amazon to be a prime beneficiary of that trend. And the stock is trading at its relatively cheapest level it's been trading at in the last few years in terms of price to earnings. And so I would say that this might be a good opportunity for investors to start considering Amazon stock as a buy. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/parkev to get your 10 stock picks now.